Good afternoon, everyone. Thanks for joining us today for our webinar, which is on preparing for major changes to DOT's Disadvantaged Business Enterprise Program. And this talking about this final rule that becomes effective tomorrow, May 9th, 2024. We can go to the next slide. So just starting out, giving an introduction. This is me, Jackie Unger. I'm a partner in PilieroMazza's Government Contracts Practice Group. As part of my practice, I help clients with all aspects of the DBE program, including obtaining certification and maintaining eligibility. In addition, I also assist clients in a wide variety of other government contracting issues, like bid protests, size and status protests, FAR and small business regulatory compliance issues, negotiating subcontracts and joint venture agreements, and investigations by the government like False Claims Act investigations. So that's just a little bit about me. I'm joined today by my colleague, Peter Ford. I'll let Peter introduce himself.
Thanks, Jackie. And thanks, everyone, for joining us this afternoon. My name is Peter Ford. I'm a partner also in the Government Contracts Group. And everything that Jackie just said about herself and what she does, I play a very similar role. And the two of us work closely with companies that are trying to participate in the federal programs designed for disadvantaged businesses and veterans and women. And that knowledge kind of shifts into this webinar also, because a lot, as we'll discuss, there are some similarities between the DBE rules and what are currently the rules for the SBA's 8A program. And we deal a lot with the 8A program, helping people navigate it. But our goal is not just to help people get into these programs, it's really to consult them, counsel them all the way through, meaning, we're there to help you guys leverage your status, leverage your DBE status, your federal status, what have you, and really make the most of it while you have it. And then just a little bit about PilieroMazza. You can go to the next slide. So we are a law firm. We're based in DC. We have offices in Maryland, and we have offices in Colorado. That's where I am. I'm in Boulder, Colorado. We have 4 main practice groups: corporate, litigation, labor and employment, and then our bread and butter is really GovCon. And I like to say that through all of our practice groups, we're trying to essentially help government contractors and commercial businesses find success, and like I said, kind of being aware of these rules, and not just being aware of the rules, but being aware of the program and benefits is really helpful in that regard if you want to succeed. I think we're about 45 attorneys, maybe, Jackie, I don't know with the exact number. Maybe it's a little lower than that, but the bulk of everyone is, the bulk of the firm is in DC, and then there are a few of us scattered in Maryland, and then out here in Colorado. You can go to the next slide. So this is just a quick overview of what we are going to be talking about today, the final rule, which came out last month and is effective as of tomorrow, so May 9th. And as you'll see, a lot of what the agency, the DBE program, did was kind of just go through each rule, and some changes were made. Others were just confirming that the way things are currently working are the way that things should be working, and that's how it's going to be moving forward. But they did make some shifts, I think most of which we think are beneficial in terms of the applicant's point of view. So we'll start off by just discussing the DBE program, which is why you guys are here. What is it? How can you benefit from it? What are the basic eligibility requirements? What are the continuing eligibility requirements? What are the ins and outs of DBE eligibility and certification? Again, that's really just going to be talking about what are the standards for getting in and staying compliant with the regs. What are the prime contractors' obligations in using DBE subcontractors? And then we'll segue into how is DBE participation counted towards DBE goals? And then we'll just go through some of the other key highlights from the final rule. Again, understanding that everything right now hasn't gone into effect, and it's likely not going to start going into effect until tomorrow. So I guess the timing of this presentation is very good in that regard. And with that, I'll turn it back to Jackie.
Thanks, Peter. So we just wanted to start out with a high-level overview of the DBE program in case anyone listening is not very familiar with the program. Probably most of you are, so I'll try to keep it brief. But the DBE program was initiated in 1980 with a goal of prohibiting discrimination in the award and performance of DOT-funded contracts. And so the program is aimed at leveling the playing field by providing DBEs a fair opportunity to compete for federally funded transportation contracts. So this is DOT funding that comes from the Federal Highway Administration, the Federal Aviation Administration, or the Federal Transit Administration. So in order to receive the DOT funding from these administrations for state and local contracts, recipients, they're like state and local DOT and related agencies, need to develop and implement a DBE program that conforms to DOT standards and the regulations that we'll be talking about today. Generally, not less than 10% of the amounts that are made available through the agencies need to be expended with DBEs, although there's not a set quota that needs to be met. I'll also say the FAA has a separate DBE program that's specifically for concessions and airports, the AC DBE program, which follows most of the same standards and regulations that we'll be talking about today, except it has different size standards for that one. So we're not going to focus on the AC DBE program today. We're focusing on the DBE standards, but there is this very similar program that's out there that was also impacted by the final rule. Okay, we can go to the next slide. So here's a high-level overview of the different players and their roles in the DBE program. So starting at the top, we've got the U.S. Department of Transportation. And US DOT provides ultimate oversight for the program and enforcement, particularly of recipients, and making sure that they're complying with the DBE program requirements. And they also hear appeals of certification denials and decertifications of DBE firms. Then we have the state and local transportation agencies. These are the recipients of federal DOT funding that are required to have their DBE programs. So they are the ones that actually handle the certifications of applicant DBE firms. And the DBE program is unique because it not only deals with regulations that are applicable to the DBEs, but also to the recipients themselves, as well as to prime contractors. So they're all implicated by the program. And while DOT is responsible for the DBE program at a high level, the national level, the recipients do have some flexibility in their own DBE programs and how they implement that program at the state or local level. So it's important for DBE firms and prime contractors as well, the parties to the program, to understand how the DBE program works at that state or local level, since although they're required to meet federal regulations and those standards, there is some leeway in how they implement it. And so the state and local transportation agencies are required to set DBE participation goals. But again, the recipients may not use quotas or set aside contracts for DBEs. The goals are aspirational. And they also have the obligations for monitoring and reporting, making sure that the DBE program requirements are being met both by DBEs and prime contractors, and reporting on DBE awards and data about DBE firms and the recipients' programs. So then we have prime contractors, which can be DBEs or non-DBEs. Prime contractors generally are required to use good faith efforts to use DBE subcontractors to meet their goals on their prime contracts. And they also have reporting requirements. And we'll get in later in the program a little bit more about what those good faith efforts need to entail. And then we have the DBE firms themselves. And so they have compliance and reporting requirements for continuing certification. And so we're going to dive into what's required for compliance, how do you get certified, and how do you maintain that compliance in just a little bit. So next slide, please. And then just high level touching on the final rule. As we mentioned, it becomes effective tomorrow. The proposed rule came out in July of 2022. US DOT received approximately 400 comments from stakeholders, including state DOTs, DBE firms, and non-DBE firms, as well as individuals. And so because of all of that input on this revamping of the DBE program, it's taken a while for DOT to come out with the final rule. Close to 2 years later, in April 2024, it came out. And so it has some major changes to the program that we'll talk about today, like updating the personal net worth thresholds, updating certification provisions to have less prescriptive rules and allow more flexibility, revising the interstate certification process, and modernizing the rules for counting material suppliers. So those are just some of the things that we'll touch on today. But yeah, it's a big change. And as Peter said, it also confirms the way that the regulation should be interpreted moving forward as well. So we'll work in, as we're talking about the current standards, how the final rule changes, how things will work. So with that, I will hand it back to Peter to get us started with the certification standards.
Thanks, Jackie. So real quick, this is really the definition of a DBE broken down into pieces, so to speak. So you need to be a small business concern. You need to be for profit. You have to be owned and controlled by socially and economically disadvantaged individuals. And I'll kind of touch on what do those terms mean. Are there instances where someone is presumed to be socially disadvantaged? And then we'll kind of segue into what does ownership mean. You have to own at least 50% of the business. Jackie will get into, how does that ownership have to be held? What does it mean to be unconditional? And what does it mean to have direct ownership vis-a-vis indirect ownership, which is a change that really came out of this final rulemaking. And then control. So controlling not just the daily business operations, but the long-term strategic policy setting. And again, Jackie will kind of get into what does control mean other than just doing that, meaning what are the other control criteria. And then you can go to the next slide. So size requirements at a high level, you have to be small to participate in the DBE program. You have to be small if you want to go after these contracts from the Federal Highway Administration, from the FAA, and from the FTA. But there are two specific size requirements. One, I'll just refer to as the statutory gross receipts cap, or the DOT cap. This is a business size limit for DBE program applicants and certified DBEs seeking to participate in federal highway and FTA assisted contracts. As of the final rule, the statutory gross receipts cap is 30.72 million. And notably, this standard is measured based on a 3-year average, not a 5-year average, which probably sounds confusing because SBA has switched to a 5-year average, and even more confusing when I discuss the next standard, which is a separate size requirement that is based on a different period of measurement. But there was discussion, not out of this final rule, but a few years back, about switching from 3-year to a 5-year, and specifically in October 2020, there was a DOT memo where they clarified that even though the SBA had shifted to a 5-year period of measurement, it's still 3 for purposes of the DBE cap. And again, this is the statutory gross receipts cap as required under the Fixing America's Surface Transportation Act. The statutory gross receipts cap is adjusted for inflation, which is presumably why it's not 32 million or 31. I mean, it's not a perfectly round number, but that is a result of the Department of Commerce data that feeds into that threshold and how it can get adjusted. Importantly, the DOT cap, it doesn't apply to firms eligibility for participation in FAA assisted projects. It does apply to federal highway and FTA projects. And also, like I said, it applies to anyone who wants to participate in the DBE program. Separately, there's what I'll call the SBA size cap. And this is specific to DBE certified DBE participating firms. And it also encompasses the firms that are going after the FAA type projects, the FAA assisted projects. And that just basically says that if you're a DBE firm, you have to be small under the NAICS codes applicable to the work that the firm does. These size caps, these size standards vary by industry according to the NAICS codes defined by the SBA, and the SBA's NAICS codes and their size rules generally are in 13 CFR Part 121. It is measured based on a 5-year average. So what that means, whether it's 3 or 5, you look at the last, the most recently completed fiscal year. So if you're looking at your size as of today, you would be using 2023 and going back a full 5-year period. And for purposes of the statutory gross receipts cap, be using 2023 and then going back a 3-year period. For purposes of the SBA size cap, firms can have multiple NAICS codes listed, meaning if you're in a particular industry that has various subcomponents, then you may want to list all of those NAICS codes, and you just need to make sure that you are small for each one of them. So now we'll just segue into the disadvantage, social disadvantage, and economic disadvantage. So for social disadvantage, DOT generally follows SBA's designation of disadvantaged groups, which the SBA has designated for purposes of the SBA's 8A program. There are a total of 5 SBA designated disadvantaged groups in the social disadvantage regulation for the 8A program, and that is 13 CFR 124-103. And those 5 groups include Black Americans, Hispanic Americans, Native Americans, Asian Pacific Americans, and subcontinent Asian Americans. Notably for 8A program purposes, women are not an SBA designated disadvantaged group, but women are under the presumption for DBE DOT purposes. So essentially what that means is for DBE program purposes, there are the 5 that are from the SBA, and then there's women in addition to that. So there's a total of 6 versus 5. Members of designated groups are presumed to be disadvantaged because members of those groups have historically and currently suffered from discrimination and its effects. If someone has not identified as or been regarded as a group member for long enough to have suffered these effects, they are not someone who is intended to have the presumption of disadvantage, which gets into this whole notion of what they refer to in the regulations as a long period of time. And what that means is that this presumption is rebuttable if the applicant, despite being a member or claiming to be a member of a specific disadvantaged group, they have not identified as a member of that disadvantaged group for a long period of time. The final rule does not include a definition of long period of time. There really hasn't been one that was proposed. Maybe we should have a rigid time period, whether it's 3 years or 5 years. But they wanted to provide more flexibility. And by not including a definition, the final rule preserves the ability of certifiers to consider a person's claim of group membership and to demonstrate such a preponderance of the evidence. I think there was also a concern that by specifying a rigid time period, that could be subject to manipulation by an applicant who continues to assert a clearly invalid claim of group membership, but does so for many years. So they kept it loose, so to speak, and there is no defined term for long period of time, which kind of just shows how they're part of this shift is really going towards the certifiers and their ability to be a little more objective in their analysis, and not be stuck to, like I said, a 3-year period or a 5-year period, which could be good, and obviously there could be a downside to that as well. The final rule does clarify procedures for questioning the membership of a transgender individual or one whose gender identification is inconsistent with that on the individual's birth certificate. And those procedures are the same as questioning the group membership of any other individual. So for example, if after a proper inquiry, a certifier rebuts a transgender's individual membership in the female group, the certifier must deny the application and inform the individual of its right to apply based on an individualized showing of disadvantage and of their right to appeal the department's findings. And that scenario is a little different from an instance in which a person does not check the box for female and instead writes transgender after checking the other box. And in that instance, a certifier must inform the person that transgender is not a group whose members are presumed socially disadvantaged, and again, explain the option of applying using an individualized showing of disadvantage. And you can go to the next slide. So that was social disadvantage, and now we'll segue into economic disadvantage, which is really looking at the personal financial situation of the individual who is the qualifying minority owner or member of a disadvantaged group. And the presumption is rebuttable. It's if your net worth exceeds 2.047 million, it is rebuttable, or if the certifier can demonstrate that even though you may claim that you're economically disadvantaged, you're not under what they call a reasonable person analysis. And this is a change coming out of the final rule. Previously, there was the AASW multi-factor analysis framework, which certifiers use to determine whether an individual has the ability to accumulate substantial wealth, and if they do, the presumption is rebutted. Under the multi-factor analysis, which again is the prior analysis, not what's coming out of the final rule, the certifier could rebut economic disadvantage if it determines that the owner has an ability to accumulate substantial wealth. And in that situation, they looked at a number of things. The gross income of the individual and whether that was in excess of $350,000 over the last 3 years. Income that they have, reinvested into the business itself, the DBE firm, or used to pay taxes arising from the business. So, for example, if you're taxed as an S corporation, you're an LLC, and you're taxed as an S corporation, in that instance, the tax obligations are going to flow up directly to the members of the LLC. And in those situations, what happens typically is they receive profit distributions from the company, and part of those profit distributions are referred to as a tax distribution, and those tax distributions are essentially taken and then immediately turned back to pay the IRS. They also looked at the total fair market value of the individual's assets and whether that figure exceeded $6 million. And then they also considered transfers of assets for less than fair market value that are made within the 2-year period preceding the application date. But again, that was the old standard. Under the new reasonable person analysis, again, certifiers can make judgment calls without the burden of strict regulatory criteria, so they're not going to be held to those factors that I just kind of ran through. Having said that, certifiers must articulate a detailed explanation as to their decision, assuming they find that someone has, or the presumption of economic disadvantage has been rebutted. They can't just come up with a conclusion that has no findings leading up to it. They need a detailed decision that led to that conclusion. More specifically, a certifier will bear the burden of proving by preponderance of the evidence that a reasonable person would not consider the individual to be economically disadvantaged, even though the individual's personal net worth did not exceed the regulations limit. So this is a situation where, at least on paper, the individual appears to be economically disadvantaged just based on the personal net worth figure of, again, a little less than $2 million. And among the evidence that could be considered by the certifier are ready access to wealth, income, or assets of a significant magnitude that are inconsistent with economic disadvantage, the type of lifestyle, or generally other just circumstances that economically disadvantaged people typically do not enjoy. Liabilities and the kind of asset exclusions used in personal net worth, which I'll get into in a second, would not be taken into account as part of this reasonable person analysis. They are specific to calculating that bottom line personal net worth figure. Go to the next slide. So personal net worth, a little more on that. How do you calculate it? There are certain exclusions that the certifier must make. Specifically, the disadvantaged owner's personal net worth is calculated by excluding certain assets that include the disadvantaged owner's ownership in the applicant firm, the equity in his or her primary residence, except when he or she doesn't own the home, and then all assets in qualified retirement accounts, which this again is another change. There used to be more of an analysis when it came to qualified retirement accounts, and you looked at the present value of the assets held in retirement accounts. Now it's just a more black and white analysis, so to speak, in that it's all assets in qualified retirement accounts. So what that means is you essentially account 100% of the dollar amount associated with that retirement account, as opposed to going into a more detailed analysis. They also exclude liabilities of any other third party, and then direct payments. If these payments are made within a 2-year period prior to the application date, generally they're going to count, but they won't count, meaning they won't be attributed, the payments themselves, as assets of the individual who made the transfer. If the transfer is made on behalf of family members or to their children's healthcare, education, or legal service providers. So if, for example, the disadvantaged owner moves some assets, let's just say cash or properties, into a trust for the benefit of his spouse or the benefit of his children and you know their health, their education moving forward, then those assets, even though they're transferred within that 2-year period leading up to the application date, are going to still be viewed as assets that are no longer assets of the disadvantaged owner. With respect to assets that are included in the personal net worth calculation, these assets include those that are held separately, jointly, or as community property, but only the applicant's ownership interest in those assets is attributable to the personal net worth. So if something is owned as community property, or if it's owned jointly, it's going to be split 50-50, which just frankly makes sense. And then Everything else is generally, if it's yours, so you count 100%. So just a quick recap on the personal net worth threshold and what kind of came out of the final rule. The personal net worth threshold for a disadvantaged individual was bumped up to just over $2 million, which is the first cap increase.
Sorry, Peter. Let's go to the next slide, please, Darian.
Oh, sorry. And this is the first cap increase in 2011, increasing it from 1.32 million. And the new threshold takes into account the impact of inflation, personal assets, and completely removes retirement accounts from the personal net worth consideration, which again is a new change. And with that, I'll turn it back to Jackie.
Can we go to the next slide, please? Okay, so I'm going to talk about the ownership requirements. While the regulation for the ownership requirements has been overhauled, the overarching principle is still the same. The SEDO, SEDO, socially and economically disadvantaged owner, who I'm referring to with the SEDO, they still need to own at least 51% of each class of ownership. That's pretty much the same requirement that we've always had. That overarching requirement isn't changing. But as we've talked about, the final rule changes the focus of how ownership is analyzed in a way that's intended to streamline and make the process easier for certifiers and provide some more clarity as well to applicants. So whereas the current rule up until tomorrow requires that ownership be real, substantial, and continuing and go beyond pro forma ownership, now the final rule is instead focusing on acquisition, proportion, and maintenance of the ownership interest, those three areas. So with the intent of having a broader, more flexible focus on those areas. So first, in terms of acquisition, the SEDO must acquire ownership at fair value by an investment which must include a significant outlay of the SEDO's own money. So what this means, an investment can be through a cash purchase or a capital contribution, which could be a mix of cash and property, or it could be made through a qualifying gift. If it's a gift, though, the transferor, who the gift is coming from, must not be involved in the business in any capacity. So they have to, remove themselves from the business. One thing that's different in terms of the investment that's made in the current rule, there's an ability to contribute expertise. Now, contributions of time, labor, services, and the like are not investments or components of investments. So there has to be this cash outlay that's involved in the acquisition of the ownership interest. There is still a possibility for debt finance investments that can be used, but only if the SEDO has paid at least 15% of the total value of the investment by the time that the firm applies for certification. And the debt financing, there are strict requirements in the final rule, including that it must have commercial arm's length terms. The SEDO must be the sole debtor, so it can't be like there's another guarantor of that debt. And the SEDO has to be making, or at least the financing agreement has to provide for the SEDO to make regular recurring payments on the loan. So DOT and certifiers don't want to see a situation where a loan is taken out to acquire an interest in a DBE firm, but then there's no payments that are actually being made on that loan. It's not backed by a guarantee by the SEDO. There's no intent to actually repay it because that doesn't show that there's actually an investment by the disadvantaged owner. Let's see. So if the disadvantaged owner doesn't make an investment, or it's insignificant or disproportionately low to the ownership interest, then the firm won't be eligible. The next principle that we'll be focused on is the proportion. And what this requires is that no owner, whether it's the disadvantaged owner or the non-disadvantaged owner, derives benefits or bears any burdens that are clearly disproportionate to their ownership shares. So the focus is really on clearly disproportionate. Whereas before there was a requirement that the profits and losses be shared commensurate with ownership interest, what we saw and what DOT would see and certifiers is that certifiers would be requiring very precise proportion of dollar value, dollars and cents lining up with ownership interest. That's being taken away to focus more on clear disproportionality, so that there may be, if we're off $1 or $2 here, but there's not clear disproportionality, then that investment can still be an ownership interest there can still be eligibility there. So as written in the final rule, proportionality does not require exactitude, and owners have latitude up to the point at which the benefits and burdens of ownership are clearly disproportionate or undue. So again, this gives more flexibility to DBEs with an intent to elevate substance over the form. And then the last focus is on maintenance and requires that the disadvantaged owner maintain its investment or their investment and their proportion relative to those of the other owners. So this is looking at what happens with that investment over time as the DBE firm continues its operations. So it's important that the CEDO not withdraw or revoke her investment. Also, if a co-owner makes a significant additional contribution of cash or property to the firm, then the CEDO also must increase her own investment to a level so that there's not that clear disproportionality to the non-CEDO's investment. So you can't, even if the CEDO makes an appropriate contribution to get their initial ownership interest, if there are other owners, non-disadvantaged owners, that then later on, a few years later, make a major investment of cash or property, that could lead to there not being that proportionality anymore of that ownership, that at least 51% ownership interest. And so the CEDO will also have to make a similar, maybe not exactly the same, but a similar investment of their own to make sure that they still are maintaining that 51%, at least 51% ownership interest. Okay, we can go to the next slide. All right, so similar concept with control, where we have a rewrite of the regulation that controls here, but the overarching principle is pretty much the same, where the disadvantaged owners whose eligibility is being relied upon to qualify the DBE firm, they need to be the ultimate decision makers, in fact, for the DBE's operations. They need to be the ones who are actually running the show. This is going to be determined through an in-depth on-site interview, or at least this is what the final rule is anticipating, that certifiers do more in-depth interviews than they might currently be doing with the disadvantaged owners, as well as with other key employees, to really get an understanding of who is controlling the operations and running the show. Regardless of what's on paper in the governing documents of the business, the certifiers are expected to ask more questions about who's in control of decision making and what's being delegated to others, and when it's delegated, do the people who are delegated, do they come back and talk with the disadvantaged owners? So we would expect to see more detailed questioning there as part of the application process. The focus on actual control falls into 3 areas that we have listed here: managerial oversight, revocable delegation of authority, and critical and independent decision making. So in terms of managerial oversight, there are some requirements here, including that the CEDO hold the highest officer position in the company. The governing documents may not require that any CEDO obtain consent from a non-CEDO to transact ordinary business on behalf of the firm. So they need to be able to have control over all of the business's ordinary operations themselves without getting concurrence from non-disadvantaged individuals. The CEDO also must have present control of the board of directors or whatever other governing body there is of the company via the number of eligible votes. So they can't just have the ability to control the board by changing the composition of the board as a shareholder and majority owner of the company. They need to control the actual votes of the board or the governing body. There's also now written into the final rule, it says that provisions for the establishment of a quorum cannot block the CEDO from calling a meeting to vote and transact business on behalf of the firm. Because even if the CEDO has the ability to control the board, if there's a requirement that 2/3 of the board members or more are required for a quorum to even take any votes and take action, then there's a problem with those quorum requirements. This is something that DOT has seen DBE firms get tripped up with sometimes, if perhaps they're pulling template governing documents offline or working with people who aren't familiar with the DBE requirements here. Those may be, normal commercial requirements that you might see in corporate bylaws, but it's not something that is permissible in these small business programs like the DBE program. So that's now written into the final rule as something that needs to be addressed. Let's see, next, with respect to delegation, the final rule makes clear that CEDOs can delegate administrative activities or operational oversight to non-disadvantaged individuals, but the CEDO needs to retain unilateral power to fire those delegates and take back any of that authority. And in addition to that, the chain of command has to be evident to people within the company and to those outside the company who are transacting business with the DBE firm. So, you can't just delegate and have it not be clear that the disadvantaged individual is really the one in control. It's okay to delegate, but you need to be able to take that power back, and other people need to be able to tell that it's really the disadvantaged individual who's controlling at the end of the day. No non-disadvantaged participant may have power equal or greater than that of the CEDO. That means that they can't make non-routine purchases or disbursements or enter into substantial contracts or make decisions that affect the company's viability without the CEDO's consent. So on those bigger ticket things, the CEDO needs to be involved and give consent on those. The last area here relates to independent decision-making and expertise. So this is a carryover, it's written in a different way, but a carryover of the current requirements that the disadvantaged owner needs to have an overall understanding of the business and its essential operations so that they can make sound managerial decisions that aren't just administrative on their own. And that will vary by the type of business that you're dealing with, but they have to be able to critically analyze information that's provided by those to who they delegate different tasks, and they need to be able to use that information to make independent decisions. I will note that the final rule does remove some of the topics that are explicitly addressed in the current rule. For instance, there's currently a restriction on outside employment by the disadvantaged owner that conflicts with management and control of the firm. There's a requirement that the disadvantaged owner hold any required license for the business to operate. There's the potential for the certifier to consider differences of remuneration of the disadvantaged individual and non-disadvantaged personnel in the company, indicating that the disadvantaged owner should be highest paid or one of the highest paid people. And there are also explicit rules for when family members are involved in the firm and deciding who's really in control. So those current concepts are no longer in the final rule in the regulation addressing control, but it doesn't mean that they cannot still be relevant considerations for the certifier. It's just that they're kind of subsumed in these other topics that we're talking about. Because, like, for instance, with outside employment, if the disadvantaged owner does have outside employment, then the totality of the circumstances of who's in control may show that they don't have the understanding of the business, and they're not involved in that decision making, and they're not really the one running the show because they're off with their other employment, for instance. So it doesn't mean these concepts won't be considered. They're just not explicit considerations for certifiers moving forward. And then the last point that I have here is a requirement from the current rule that only independent businesses can be DBE certified. And what this means is that if there's resource, it's really about looking at the relationship with other businesses, whether they're DBEs or non-DBEs, and making sure that the applicant or the DBE firm is not reliant on resources from other companies in order to be viable. That can be resources like sharing personnel, facilities, equipment, financial support, any other essential resources. The one exception that's explicitly made in the final rule is that a firm may share essential resources and deal exclusively with its affiliates, which would be another firm that the CEDO controls and is the majority owner of. So there can be that sharing as long as that same owner controls and owns the other firm. Okay, can we go to the next slide? So a few other takeaways on the final rule regarding ownership and control considerations. Peter alluded to before about indirect ownership that's permissible. The final rule does clarify that indirect ownership of a DBE firm is allowed if the CEDO owns and controls the parent entity. So that means a subsidiary can be certified. There doesn't have to be direct ownership by the individual disadvantaged owner, as long as that disadvantaged owner owns and controls, majority owns and controls indirectly through the parent entity. In terms of, there's a new requirement, and maybe this is clarifying what DOT's intent always was, but is now explicitly written into the final rules, that a DBE firm has to have operations in the business for which it seeks certification at the time it applies. So this doesn't require that an applicant have performed on or executed prior contracts, but it has to be in a position to work on a DOT-assisted contract if it were to be certified. So it can't be, you can't go create a firm and the very next day, when it doesn't have, any equipment, ability to operate, any personnel, anybody who is actually going to do the work, go out and apply for certification. So it needs to have some operations in place. A very important change is that the regulation now explicitly allows for unanimous consent requirements for extraordinary actions by the DBE firm. Whereas previously the rule really focused on the disadvantaged owner controlling all decisions of the firm, and certifiers often would take that, verbatim, literally, and not allow minority owners to have any say on any decisions of the firm. Now it's explicitly noted that there can be unanimous consent by those minority members for certain sorts of extraordinary actions, with examples being like a sale of the company or substantially all of its assets, mergers, or a sudden wholesale change of the type of business. So that helps give some flexibility to DBE owners and give some say to minority owners of those firms over the company decision making. And one last point here is that the final rule encourages, it doesn't require, but it encourages certifiers to allow curative measures to correct defects in eligibility. So like I talked about before, a lot of times the governing documents will have some restrictions on the disadvantaged owner's ability to control the company by itself, with like veto rights for minority owners or the quorum requirement or various other things. The final rule encourages certifiers to go back to the applicant and point those issues out and give the applicant a chance to make changes where they can be easily made, rather than just denying the application straight out. And so that is really beneficial. Hopefully certifiers will go forward with that. Really beneficial to those DBE applicants to have kind of a second bite to make those improvements where needed. Okay, can we go to the next slide? So I just wanted to point out very quickly that there are special rules for native-owned firms. This isn't really changed by the final rule, but just wanted to point out a firm that is owned by an Indian tribe or a Native Hawaiian organization may be eligible for certification, but it still needs to meet the size standards and be controlled by socially and economically disadvantaged individuals. Those individuals don't have to be tribe members, but they do have to be socially and economically disadvantaged. There are special rules for ANC-owned firms, however. Basically, if the ANC is 8A certified and participant in SBA's 8A program, it doesn't have to submit the application, it just submits a letter with proof of its 8A certification, and it's not required to meet the size, ownership, or control requirements applicable to other DBEs. If it's not 8A certified, then it's still subject to the same criteria as entities owned by Indian tribes and NHOs. So, okay, let's keep going through. I'll hand it back to Peter to talk about certification.
Thanks, Jackie. And just real quick, we're probably going to, there's a lot of material, so we're probably running up against the clock here. So if you do have questions, please put them in the chat, and then Jackie or I will get back to you at some point this week. I'm just not sure that we're gonna have a chance to answer or time to answer questions at the end. So real quickly on the certification process, and I'm just gonna go through this somewhat fast, given that a lot of it is not new. DBE firms must participate in the Unified Certification Program established in each state. The UCP provides one-stop shopping such that an applicant is required to only apply once for DBE certification, and that will be honored by all recipients, certifying agencies in the state. They're required to fill out what's called the Unified Certification Application. And then as part of that, you provide supporting documentation, which is, just a number of items used to confirm your eligibility. So federal tax returns for the company and for the socially and economically disadvantaged owner, a list of equipment, list of licenses, bonding and financial capacity, if there are any lease or loan agreements, bank account signature cards, so they can see that the socially and economically disadvantaged owner has control and can over those accounts and can write checks. And then the work history of the firm, the work that you've completed, and your contract history, and then maybe some payroll records. They're also they have an on-site visit piece, and the UPC is required to perform an on-site visit to the firm's principal place of business and any job sites, if there are such sites on which the firm is working at the time of the eligibility investigation in the local area. They're going to do interviews, and the interviews of the principal officers will entail a review of resumes and their work histories. They can also review key personnel of the firm if necessary to help the certifier determine who controls the firm. So just a heads up, if you're applying, expect an on-site visit and just make sure that you're ready. And maybe some individuals within the firm, you need to have a conversation with them in case they are approached by the certifying agency and they're not necessarily ready to answer those questions or answer them how you see fit. The UCP is not required to process an application from a firm with a principal place of business outside the state if the firm is not certified in its home state, where it maintains its principal place of business. What that means, and this is what they refer to as what's called, and this is a new term of art, a jurisdiction of original certification, which essentially just means that you must get certified where you have your principal place of business, at least for the first certification. And then for interstate certification purposes, the second state can simply accept the home state certification. If it doesn't, there are specific procedures that the state must follow in terms of gathering and reviewing DBE documentation from the home state. And generally speaking, the second state must certify the firm unless it has good cause to believe the certification in the home state was erroneous or simply shouldn't apply.
Can we move to slide
Yeah, you can go
forward?
to the next. You can move forward. So I already talked about that. For the interstate certification, all you need to do is, once you have that certification of your own, put a cover letter together identifying all programs in which you're DBE certified, a new, what they call a declaration of eligibility, which is a change. They got rid of a sworn affidavit and instead are relying on a certification of eligibility, declaration of eligibility from the disadvantaged owner. Generally speaking, for interstate certification, they have 10 days. And within those 10 business days, they have to review everything and certify the DBE immediately. And then this is another change. If they go down the path of decertifying you, meaning you're certified in one state and you apply for interstate certification for another state. If the second state says we don't think that you should have been approved at all, or we see other issues that just didn't come to light as part of the first application, and they say we're not going to certify you through interstate certification, that decision doesn't just impact the certification with that state, it impacts all jurisdictions, so all states where the DBE is certified. So if you apply for interstate certification, just be mindful of the fact that if it doesn't get accepted, you're running the risk that your home state jurisdiction and any other states in which you're certified, you're going to lose that status. So just something to keep in mind. So some requirements, there's the annual certification, where you're providing a affidavit every year. And then again, along with the supporting documentation, there also are what are called changes in circumstance, and these changes in circumstance trigger a reporting requirement. A certification by the UCP, including an unannounced on-site review, may take place in light of changed circumstances or other information regarding eligibility. And if you fail to make a timely notification of a change in circumstance, you will be deemed to have failed to cooperate, which could result in the removal of your eligibility. And then the recipient, the UPC, may also temporarily suspend a DBE if it fails to notify the recipient of material changes, fails to timely file its annual affidavit of no change, or if there's evidence of a change in circumstance impacting its eligibility. And these material changes that trigger a reporting requirement, these changes in circumstance, they're what you think they would be. Changes in the firm's size that may impact whether the firm is small. Change in disadvantaged status. Generally, this is going to relate more to economic disadvantage as opposed to social disadvantage. Changes in ownership or control. So revising your documents or bringing on a new owner, or a new minority owner, or any other material information that you provided as part of your information, as part of the information in your original application. Go to the next slide. So BD opportunities for DBE firms, and again, there's really nothing new here. There are what are called recipient business development programs, where the recipient, the state, provides BD training and assistance to DBEs. Here, the goal is to help the firm move into non-traditional areas of work and or compete in the marketplace outside the DBE program. And then the DBE must develop comprehensive business plan and identify the firm's business targets, objectives, and goals if you want to participate in one of these BD programs. And then there's the mentor protege program, or the recipient mentor protege programs. Recipients of the state contracting agencies can establish a mentor protege program in which another DBE or non-DBE firm is the principal source of BD assistance to a DBE firm. Here, the purpose is to further the development of DBEs, which is similar to the goal for the general BD programs. mentor-protege relationships need what are called written development plans approved by the state. And the development plan must set forth the objectives of the parties, their respective roles, as well as the duration of the mentor-protege arrangement and or the services, resources being provided by the mentor to the protege. The formal program guidelines, meaning the mentor-protege program guidelines, they're going to vary a little depending on the particular state, but generally speaking, and this probably goes without saying, you got to be certified prior to taking advantage of the mentor-protege program. So before you apply for the mentor-protege program, you need to be certified as a DBE. And then training and assistance that the mentor provides to the protege, that may be reimbursable under some state DBE mentor-protege programs. And with that, I'll turn it back to Jackie.
Okay, we've got a few more slides here. Sorry, I'm getting some feedback. So I'll try to get through them quickly. Sorry that we're running over. We want to cover prime contractor obligations and changes to counting DBE participation. So let me try to cover that pretty quickly. So for prime contractor obligations, we have the same requirement that prime contractors have to make good faith efforts to meet their contracting goal, which can be met in one of two ways. They either actually get commitment from DBEs that are sufficient to meet the goal for the contract, or they document adequate good faith efforts to meet that goal, even if they don't end up being able to subcontract with DBE firms in a sufficient amount to meet the goal for the contract. In terms of documenting those efforts, I have some examples here of efforts that a prime could make. They could do market research and then reach out to DBE firms that they find, attendance at matchmaking events, negotiating with DBEs in good faith, working with them to obtain bonding, lines of credit, or insurance, or to obtain equipment, supplies, and materials for example. So generally, where we have a change with the final rule, generally, the prime has to identify the DBE subcontractor, scope of work and dollar value in their proposal or within 5 days after bid opening. But there are new exceptions in the final rule for negotiated procurements and design build procurements. So, generally a promise just to use DBEs after the contract award is not a good faith effort to use DBEs. You actually have to identify who you're going to use. But for negotiated procurements, such as for professional services, an offeror can make a binding commitment to meet the goal at the time that they submit their bid or present their initial proposal, and then wait up until, but before final selection, to provide the detailed information about the DBE participation. So they have more time to actually identify the DBE and what the scope of work is that they'll do. It still needs to be provided before the final award selection, though. It's a little bit different for design build contracts. In the situation where there's minimal project details that are known at the time of the project letting, the recipient may allow offerors to submit what is termed a DBE open-ended performance plan with its proposal. In that plan, the prime contractor would commit to meeting the goal, DBE goal for the contract, and they would provide details of the types of subcontracting work or services that they'll solicit DBEs to perform, but they don't have to actually have identified the DBE for that specific scope of work at that time that they're putting in their proposal, because there's just kind of a lack of information about what that scope will necessarily entail. And so there's going to be time after award to identify, to look for and sign up those DBEs. So it replaces the need to commit to specific DBEs or submit good faith efforts at the time of the proposal. But once the contract is awarded, there's ongoing monitoring and oversight of the contract by the recipient to evaluate good faith efforts to comply with the plan through the course of performance. So we've also got a prime contractor has to provide prompt payment to DBEs for satisfactory performance within 30 days of receipt of payment from the recipient. And the final rule imposes more requirements on the recipient to proactively monitor and oversee the prime contractor's compliance in this regard, and making sure that they're complying with those prompt payment requirements. We can go to the next slide. Here we've just got the prime contractor limitations and consequences of breach. So the very important limitation is that the prime needs approval from the recipient before it makes any reductions or changes to a committed DBE scope of work, such as doing work with its own forces or a non-DBE firm, or even substituting to use another DBE firm. Once the DBE firm is identified and committed in the proposal, the prime needs approval from the recipient to make changes to that. And there's a specific process in the regulation about getting that approval and notifying the DBE firm and giving them a chance to respond before there's any substitution or termination of the DBE. Here we've got the failure to comply with DBE program requirements constitutes a material breach of the prime contract, and the potential consequences that may result if there's that breach there. Okay, we can move on. The last topic that we wanted to cover is changes in counting DBE participation. So some of the concepts remain the same, that for instance, a DBE has to perform a commercially useful function for any credit to be taken. This generally requires that they have to self-perform at least 30% of the work with their own forces. If they don't, they'll be presumed not to be performing a commercially useful function. Or if they subcontract out an amount that's more than normal for the industry, the DBE firm, even if it does less, it can try to show that the amount that it's performing is normal for the industry, but that's kind of the rebuttable presumption. They have to do at least 30% of the work. And they have to be responsible for execution of the work themselves. So, you know, as long as a commercially useful function is performed, then the amount of DBE credit that's earned on a particular contract is going to depend on the type of work that's performed by the DBE. So the focus here is, in the final rule, the changes relate to how to count expenditures with DBEs for materials or supplies. And the final rule adds in a new category here, the distributor category. So we currently have for manufacturers that are DBEs, when their expenditures to manufacturers, the prime can count 100% of the cost of materials or supplies that go to the DBE manufacturer. For regular dealers, you can count 60% of the cost of those materials or supplies. A regular dealer is a firm that owns or operates a store or warehouse in which the materials are kept in stock and regularly sold to the public, or it can include selling bulk items or items that aren't normally kept in stock only if the DBE operates the distribution equipment used to deliver the products. So the distributor category is different from the regular dealer because it would be companies that still regularly sell or lease the materials at issue, but they drop ship them instead. They don't keep the materials in stock themselves. They don't use their own distribution equipment to get the materials where they need to go. So, you know, this opens up an opportunity for DBEs to become distributors, and still in that situation previously, they would be treated as brokers where only their fee or commission could be counted, not the cost of materials. Now there's this different distributor category where 40% of the cost of materials can be counted, but to be a distributor, there's a very important requirement that they actually take title and assume liability for the materials from the point of origin throughout transportation to the final destination. The point of origin, for instance, could be the manufacturer facility. So they actually have to assume that risk for the materials that they're providing in order to get that 40% credit. Again, if they don't, they would be treated as a broker where only their fee or commission is counted. And then the final rule also requires recipients to undertake proactive upfront investigation as to the DBE's rule before award is made. So if a DBE is identified that they're going to be a regular dealer or a distributor, the certifier is going to do a more detailed analysis to actually try to determine, you know, what are they going to be doing? Do they qualify? Do they have the materials in stock or not? Are they is there a distribution agreement that shows that they're taking title to the materials? There's going to be more of that investigation to make sure up front before award and performance that they actually meet that definition in the regulations. Okay, we can move on, please. So this is just a wrap up now. What we've already talked about, key changes from DOT's final rule that we've seen. It's going to take effect tomorrow. It provides more flexibility both to DBEs and certifiers in the certification standards. I will say, you know, more flexibility to certifiers is a good thing. They don't have to follow such rigid standards, but it also allows for more subjective judgments, which can lead to more inconsistency from certifier to certifier. So there, we may see differences in opinion in how some interpret the same factual circumstances. The certification procedures are more streamlined and hopefully will result in DBEs having more opportunity to correct deficiencies rather than getting a straight out denial. And as we've just talked about, there are changes to counting credit for DBE work, which should open up more opportunity for DBEs to get certified and act as distributors and have more credit taken for that work there. And then we expect to see more increased and more proactive recipient monitoring in the various aspects of the DBE program, making sure that prime contractors are being compliant and making sure, you know, checking on whether the DBE qualifies for the type of work that it's intending to perform. Next slide, got our last slide here. Thanks to all of you who are sticking around with us. Can we move forward? Infrastructure spending coming out of Congress, and that funding is flowing down to state and local agencies. So we expect to continue seeing new infrastructure opportunities being released over the next several years as well as that funding comes out. So these opportunities are just continuing to increase. Keep looking out for them. Small disadvantaged businesses should consider applying for DBE certification, especially as we're seeing more streamlined certification procedures. Large businesses need to familiarize themselves with the DBE requirements and identify potential DBE partners. And, you know, as we talked about, as you've seen, the final rule makes significant changes to the DBE landscape. So it's really important to understand what these changes mean and what their potential effects are. So, you know, if you have any questions about how to comply with the new requirements, feel free to reach out to us. It's important that whether you're the prime or a DBE or applying, that you understand what the regulations are actually requiring so that you make sure that you're compliant with everything. So with that, we can wrap it up. I know since we're significantly over here, thanks to everybody for hanging out with us this afternoon. We will feel free to send in your questions. You also have our contact information here, so feel free to email us any questions that you have. Since we're well over, we're not going to answer questions right now, but we will follow up with you to answer those questions. I hope that you guys have gotten some good insight today about what the final rule entails and how to be compliant with it moving forward. Thanks for listening to us today.